Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. One more thing before we get started, you'll see in the description of the video there will be this section here, which is click on this link for descriptions links to the other videos mentioned in this preview on different topics about the SPX indicator. So this is a Google Drive link. I'll show you where it takes you to now. So when you click on that link for the Google Drive, this is where it takes you to, which as you'll see is a list of different topics and links to the videos on the specific topics. These topics go into more detail. We may reference some of these topics very briefly in today's video, but when we reference to go look at the video that provides more details, then you'll just simply click on this link and go to here, and then you'll be able to click on the link that you want to see a more detailed video on a certain topic. Thank you. Hello, in today's video we'll be taking a look at the Thursday, November 6, 2025 trading session for the SPX CBOE index. We'll be utilizing the day trading GPS SPX Daily Key Levels indicator for making our trades, and specifically we're using the V2.0 version of the indicator, which was just released a few weeks ago. Okay, so some of you may be already familiar with how this indicator works from seeing our other videos on using this indicator that we've put out recently. If you're new to this channel and you have not seen those other videos, this video is going to be a lot shorter than the other videos. We're not going to go into all the different aspects of this indicator like we do in the other videos. So if you'd like to understand more on how this indicator works, what all the daily key levels mean, and how this indicator works as far as your stop loss levels and the other aspects of the indicator, then I would invite you to first take a look at some of our other videos and then come back and watch this video afterwards, because we're not going to go into all the different detail in today's session. We're just going to make this video a lot shorter. Okay, so here we have the 9:30 a.m. opening candle for this session. As you can see in this particular session, the opening candle has gapped way below the indicator's bull bear key price level for today's session, which was 68.0853. This is an example of one of the rare instances where a 9:30 a.m. opening candle closes out of range in order to take a trade off of the bull bear key price level. So here is one of the links that was that you saw in the preview. If you click on the link found in the description of this video, that is a link to videos on other topics concerning this indicator, and this is one of the links there, which is on a YouTube video regarding the topic of how to recognize opening candle trades to avoid on the SPX 9:30 a.m. opening candle closing above or closing below the daily updated bull bear key price level given by the indicator. And then also there is a PDF document on additional notes regarding the video on recognizing opening candle trades to avoid. So you can click on that link. It'll show you the links to all the topics on the other various topics on this indicator, one of which is this, and then you can have the links there, and you can watch the video on that. So I'm not going to go into a whole bunch of explanation on that. you can simply watch the video, and you can also look at this document on the Google Drive. But this is an out of range 9:30 a.m. opening candle. With this indicator, there's no requirement that you take the 9:30 a.m. opening candle trade. If you are inclined to take one, then normally with this indicator, then this would be an example of one that you would avoid. This happens perhaps 5, 6, 7, 8 times a year out of the 250 to 255 SPX sessions per year. Okay, so what you do instead is, when you're avoiding the 9:30 a.m. opening candle, which again, there's no rule or obligation with this strategy that you have to take the 9:30 a.m. opening candle trade. If it is within range, there's no requirement that you still take that. You can simply wait for a price action to play out and instead take your first trade later on in the session. So just bear that in mind, that the 9:30 a.m. opening candle trade is an optional trade. There are rules surrounding when to take it and not take it. However, it is not a requirement that you have to take that trade under this strategy. It is simply an option. Okay, so in this case, in this particular session, since this is an exception, there is no trade on this opening candle. However, as you can see, the candle is opening and closing near the S1 level. So our first trade is going to be off of the S1 level. With this indicator, your standard at the money play is going to be an option strike closest to the level that you're trading. In this case, that is the S1 level, 67.9156, and the closest strike in SPX to this level is the 67.90 strike. So if you take a bullish trade, it is the 67.90 call, and on a bearish trade, the 67.90 put. There are always 3 different options of what strikes you can take for a trade taken off a particular main level. The main levels with this indicator are the bull bear key price level, the R1 through R6 levels, and the S1 through S6 levels. So you can take bullish or bearish trades off of any of these levels throughout the session, depending on if price action dictates a bullish or bearish trade off of one or more of those levels. Okay, so in this case, we have a bearish bias for the session. So unless we see confirmations that that bias is going to change, then and that a bullish trade is warranted off of the level, then we're looking at a bearish trade. Your first opportunity for the bearish trade is this 9:34 a.m. candle close below S1. The second possible entry is this candle close at 9:38 a.m. The 67.90 put is the standard at the money play. As I stated, there are also 2 other strikes that you can use that are out of the money strikes. We go into how to determine those in our other videos if you want to watch our other session videos. We're not going to go into that today, and we also have a link to a video that is specifically on that topic, which explains what the 2 other out of the money strikes are on any given level that you're trading, if you don't want to use the at the money strikes, and how to determine those out of the money strikes on a given bullish or bearish play from any level. So watch that video if you would like to see more on that particular topic. The 67.98 at the money put on the 9:30 a.m. candle close is the price on the candle close is $18.70. On the 9:38 a.m. candle close, if you chose that one instead to take the entry on, The price on the candle close of that is $17.40. The tight stop loss to use on this is the QL above the level that you're trading. In this case, the QL above S1. The standard stop loss on this bearish trade, trading from this S1 level, is the first midpoint above S1, which is this level here. This is the mid BBKPL S1, the first midpoint level above the level we're trading, since this is a bearish trade. Now, if you miss these two entries here, you also could have entered here, as this is still within range. However, you'll be paying a lot more for this. I believe that this one here was more in the $23 range here. So as you can see, that's quite a bit more expensive. It is, however, still within range. However, if you miss these and miss this candle here, then you had another opportunity here on this 9:48 a.m. candle, which you can see the wick went back up to S1 and still closed below. And so on this 9:48 a.m. candle, it is still also within the acceptable range for an S1 level base bearish play, as it is not near the S2 level. The tight stop loss on any of these plays are going to be the same, the QL above. The standard stop loss is going to be the same on any of these plays because it's based on the level that you're trading from, and that is this midpoint here. The price on this close of the 67.90 at the money was $20.70. With this indicator, you're basically deciding between two different types of trades depending on what type of trader or what type of trade that you want to do. So if you're a scalp trader, or in this particular instance, if you prefer just taking a scalp trade, then your target with this indicator is a one level move in your favor. How that is determined is the level that you're trading from, the direction that you're trading, in this case bearish, and you look one level down, that's S2. That is your scalp exit on a one level move. When using this indicator for scalps only, with scalps only, there is no stop loss adjustment. It is a 100% closeout of however many contracts you're trading, whether you're trading one contract, two contracts, three contracts, 5, 10, 20, or what have you. On scalps, when it hits your one level move in your favor, you are closing out all your contracts. There is no stop loss level. There's no stop loss level adjustment. On scalps, you are simply closing them out. So on the 9:50 a.m. candle here, you have the one level move in your favor from S1 bearish play down to the level below S2. The 67.90 at the money put price on the candle close is $25.70. Now, if you entered on the 9:48 a.m. candle here, that's a $500 profit. If you entered on the 9:34 a.m., then that is a $700 profit. If you entered on the 9:38 a.m., then that is an $830 profit. Remember, these are per put option. So what we're showing you here is the profit on one. If you were trading more than that, then trading multiple contracts, then you would multiply that figure times the number of contracts you're trading. Also, these profits do not include any commissions that you may be paying to your broker. Now, the other type of trade that you're doing with this particular strategy is called a regular trade. The regular trade differs from the scalp trade is that it requires a minimum 1.5 level move in your favor. And then when it reaches the minimum 1.5 level move in your favor, you then have several options as to what to do once it's reached that minimum required level. And that is outlined here in this comment. Before we get to that though, you'll see here that the 9:58 a.m. candle hits the YDL level, yesterday's low. Keep in mind that YDL levels can be potential reversal points or stalls. So you also have to be cognizant of when it hits a level like this after it's already made a move in your favor, that you have to be cognizant here of the fact that since it is the YDL level, that there is a potential stall or potential reversal that can occur at the YDL level, since that is yesterday's daily RTH session low. Now on this particular 958 candle close, the at the money 67.90 put was $34.40. So that is a $1,370 profit on the 9:48 a.m. entry if you use that one, a $1,570 profit on the 9:34 a.m. entry if you use that one instead, or a $1,700 profit on the 9:38 a.m. entry if you use that one instead. At 10 a.m. it hits the mid S2, S3 level here. That is the 1.5 or 1.50 level minimum required move for a regular trade. So this is the initial target required for a regular trade of 1.5 levels. That is calculated by taking the level you're trading from, S1, and since it's a bearish trade, we're looking down. One level is S2. The next midpoint level is the half level. So that is your 1.5 levels here, mid S2, S3 from trading at this level. So the put price on this candle close is $39.20. That is an $1,850 profit on a 9:48 a.m. entry, or a $2,050 profit on the 9:34 a.m. entry, or a $2,180 profit on the 9:38 a.m. entry. Here we have the comment about what are the options you have once it reaches the minimum required 1.5 level move on a regular trade. So on a scalp, it's closeout only, one level move. However, on regular trades, once it reaches the minimum required 1.5 level move, you have several different options as to how to handle once it's reached this minimum required move. Your first option is 100% closeout, closing out all your contracts regardless of how many contracts you're trading. The second option is to, instead of closing out, adjust your stop loss on all contracts to break even. What that means at this point is, initially your stop loss on the entry is a level-based stop loss. Whereas now, when the adjustment is done, now we're adjusting the stop loss to the option price. So in the case of break even here, if you just wanted to adjust, instead of closing out contracts, adjust your stop loss to break even, then you would adjust your stop loss to the price that you paid depending on where you entered. Or add 10 to 15% profit buffer, that's what PB stands for, on top of break even. So if you were adjusting to break even and your entry was 1870, then you would add somewhere between a 10 to 15% on top of the 1870. Let's just call it, as example's sake, $2. $2 on top of 1870 would mean if you wanted to add a profit buffer within this range, then instead now your stop loss would be $18.70 plus the $2, or $20.70. Whereas if you entered here, adding $2 would make it $19.40, or here it would make it $22.70. Then at each succeeding level move in your favor after the initial minimum required 1.5 level move, you have the same options decisions to make at each succeeding level. However, you have a third option here if you're trading multiple contracts. If you're trading multiple contracts, you have a third option open to you besides either 100% closeout or adjusting your stop loss, and that is to close out 70 to 90% of your contracts here at this level, and then adjust the stop loss on the remaining runners to break even or break even plus the profit buffer. So as an example, if you were trading 4 contracts and you closed out 70, if you closed out 3 of them, that would be 75%. If you were trading 5 contracts and you closed out 4 of them, that would be 80%. If you had 10 contracts and closed out 9 of them, that would be 90%, or 8 of them would be 80%. Then at each succeeding, and then what you're doing is you're just having the remaining runners, and then with the remaining runners at each succeeding level in your favor, then you have a decision whether to keep adjusting your stop loss on the remaining runners or close the runners out. However, if you kept all of your contracts, let's say for example you were only trading 1 contract. If you're only trading 1 contract, then your only option is 100% closeout or adjust your stop loss because you only have 1 contract. So if you did adjust your stop loss here and you didn't close out here and you instead adjusted your stop loss, then on each, after this minimum required level here of 1.5 levels, then if you did not close out all of them, then if you adjusted your stop loss to break even or break even plus the profit buffer, when it then reaches the next succeeding level in your favor, then you have the same options again to either close out or further adjust your stop loss. If you already adjusted your stop loss at the 1.50 level here, which is the minimum required move, if you already did adjust your stop loss at that level, then you would add an additional profit buffer at each succeeding level in your favor on any remaining contracts that you do not close out at each level. Okay, so when it does hit the 1.5 level move here, we have the 67.90 at the money put price on the candle close is $39.20. So on the 9:48 a.m. candle, that's an $1,850 profit. If you instead took the 9:34 a.m. candle, then that is a $2,050 profit. And on the 9:38 a.m. candle, that's a $2,180 profit. Here at 10:36 a.m., it hits the S3 level. Now we have a 2-level move in our favor, and this is the minimum ideal move for a regular trade. So what does that mean versus an ideal move versus a minimum required move? The minimum required move is the minimum move at which to start making one of these decisions here. The ideal move is that on most sessions on most days, this is going to be the ideal move because of the fact that on most sessions, a 2-level move in your favor is typically going to be the max amount. So you want to be more cognizant of closing out all of your contracts at a 2-level move. However, on high volatility days, a 2-level move is generally not going to be the end of a trade, and so you can keep making further adjustments. It really just depends on the context of whether we're in a normal or low volatility situation, or are we in a growing volatility or extreme volatility situation. On this 2-level move, the 67.90 at the money put price on the candle close is $53.58. So on the 9:48 a.m. candle entry, this is a $3,288 profit. On the 9:34 a.m. candle entry, it's a $3,488 profit. And on the 9:38 a.m. candle entry, a $3,618 profit. After it hits this level, it then hits the mid S3, S4 level at the 10:36 a.m. candle. As you can see, this particular candle, it wicked down and then came off it slightly. This is a 2.50 level move. So at this point, you have the same decisions to make if you still have any contracts in this trade and did not close out them all earlier. So at this point, on the candle close, it is 67.57 on the 67.90 at the money put. On the 9:48 a.m. candle entry, we now have a $4,687 profit. On the 9:34 a.m. candle entry, we have a $4,887 profit, and on the 9:38 a.m. candle entry, we have a $5,017 profit. Again, these are all based on one contract. So if you are trading multiple contracts, then you would multiply these figures times the amount of contracts that you were trading. And of course, also keep in mind that if you scaled out, then you would take the profit on the ones that you scaled out at the levels you scaled out, and then you would only have the additional profit on any remaining runners that you had at each succeeding level. Okay, so that's going to wrap it up for this particular video. If you did like the video, please like it, as it does help us with the YouTube algorithm. Again, as I stated earlier in the video, if you've not watched any videos on this indicator before, I invite you to watch our other longer videos, which will go into much more detail about how this indicator works, what these daily key levels, each of the daily key levels mean, and other aspects of using this indicator. Also, you can look at the other various topics of this indicator, including this topic up here, which was included at the link you saw in the preview that's in the description of this video. If you are interested in purchasing this indicator in return for you taking your time to watch this video today, you can email us at daytradinggps@gmail.com, and you can request a discount promo code to use on your purchase of the indicator. In return for you taking your time to watch this video today, we will send you a promo code for a substantial discount off of the regular price of this indicator. Okay, so thank you again for watching this video. We wish you much prosperity in all your future trading endeavors, and we appreciate your support of this channel.